While both strategies make money when the stock goes up, a call debit spread profits from movement, while a put credit spread profits from time and fear. If you are bullish on a stock, you have two primary vertical spread options: buying a call debit spread or selling a put credit spread. At expiration, these two strategies can be synthetically equivalent, meaning their profit and loss profiles look exactly the same. However, the journey to expiration is completely different. The choice depends heavily on implied volatility and where you think the price will end up. Let's structure them first. A call debit spread involves buying an ATM or IDM call and selling an OTM call against it to reduce cost. Conversely, a put credit spread involves selling an OTM put and buying a further OTM put for protection. You receive cash upfront. The most critical differentiator is implied volatility, or vega. Debit spreads are generally long vega, meaning they benefit slightly if volatility rises. Credit spreads are short vega. You want volatility to crush. This makes credit spreads ideal after a sharp drop when fear is high. This leads to our first decision rule. If IV rank is low, options are cheap to buy. This favors the debit spread. If IV rank is high, options are expensive. You want to be a seller here, favoring the put credit spread to capture that inflated premium. Next, consider directionality. Call debit spreads usually need the stock to move up toward your short strike to realize max profit. Put credit spreads are more forgiving. The stock can go up, stay flat, or even drop slightly, as long as it stays above your short strike. This affects your probability of profit. Credit spreads typically have a higher win rate, often 65 to 70%, because the bar for success is lower. Debit spreads usually target a 50% probability, closer to a coin flip, but they offer a higher return on risk if the move happens. Now, let's look at theta, or time decay. Put credit spreads love time decay. Every day that passes helps you keep the credit. For debit spreads, time is an enemy if the stock isn't moving. You need price action to overcome the daily decay of your long option. Assignment risk is the hidden danger. With put credit spreads, if the stock crashes below your short strike, you risk being assigned shares. This usually happens near expiration. If you are assigned, you must buy the stock at the strike price, which requires significant capital. Call debit spreads have less assignment risk because you own the long option. The risk is on the short call leg, but your long call covers it. However, always close spreads before expiration. Do not hold through the final bell, as after-hours moves can turn a winning spread into a max loss. So how do you choose? Use the put credit spread when you are moderately bullish, implied volatility is high, and you want time on your side. Use the call debit spread when you expect a sharp, aggressive move upward, implied volatility is low, and you want to leverage small capital. Here is the final summary matrix. Snapshot this to help you make your decision before your next bullish trade. Trade the volatility environment, not just the direction.